Trading is not about the quality of your good trades. It's about the quality and size of your bad ones. Okay, now this is going to be a defining factor, whether you're a good, consistent trader that trades long-term or a good trader that, you know what, has a brain explosion and can lose the whole account in one day. Okay, now this is one of our active $1 million assessment accounts. Now, the trader has been going exceptionally well. Okay, up $51,000, not far to go to hit that profit target. Now, over the course of 24 hours, the trader lost $60,000. Now, this is a really great example of what I'm talking about. The size and quality of your bad trades will define you. Okay, now let me just run you through some details because this account has got some great characteristics. For the last 2 or 3 months, the risk to reward ratio for this trader was 1 to 3 or thereabouts. Okay, consistently making just over $2,000, and on a bad trade, losing about $650 to $700. Okay, most of the time it was above 1 to 3. Okay, you cannot get much better than that. And the risk to reward ratio flipped. Okay, from 1 to 3 risk to reward to 6 to 1 risk to reward. Okay, absolutely crazy. And the total losses, $60,000 in 12 hours. Okay, now lucky they made about $10,000 along the way, but $60,000 enough to absolutely cripple the account. Okay, 3 months of good, consistent trading lost in 12 hours. Okay, the quality and size of your bad trades will define you, right? You really need to tighten the screws on this. And this is why you have a plan to protect you against events like this. And it's not just about protecting you from the events, it's about protecting you from you. Okay, now in a situation where you have access to large limits, okay, especially when you're deep in profit, well, that's when things can really go pear-shaped, and you need to understand when to switch off. And this is where you need to have specific limits for yourself, for your own trading system. And I'll be discussing this as we go through the capital management section. You need to have a set of your own trading rules, okay? Not just the assessment trading rules, but rules that are with you forever. And the banks do this, right? They have daily, weekly, and monthly limits, which are reset each month, to catch traders who are having a brain explosion and losing sight of their capital management. Okay, this is exceptionally important because otherwise you're going to end up with an account like this one where the risk of ruin now is 100%. Okay, going from a high watermark of 51,000 to only having a few $100s left in the account. There's absolutely no chance of this account coming back into play. And the really sad thing about it is, like, they've done some great trading. Okay, the win rate, 62.93%, very good. But now with the recent massive losses, the average winning trade is now less than the average losing trade. Their risk to reward ratio is 1 to 0.5. And unfortunately, this trader has been defined as a poor risk manager. So after 3 months of quality and exceptional trading, they are now defined by one poor day. The quality and the size of your losses will define you. So make sure this doesn't happen to you. Stick to the plan. And when you're in profit, make sure you incorporate your own trading limits, whether that's a daily or weekly limit, because I tell you what, it will go a long way to protecting you from black swan events as well as brain explosions.